This morning, we got the Dallas Fed manufacturing report. Let me just tell you, folks, all these are the manufacturing reports. The yellow is December, January's report. This is what you call an unmitigated disaster. I mean, again, all of these regional Fed manufacturing reports have been in monster declines. And, I thought we were in a manufacturing renaissance. It does not look like this. Now, remember yesterday, and we talked about it a couple times in the show, Lydia Hugh did a great piece outlining the two wild cards, right? Because it's not just the Fed. You've got a couple of things. First was a quarterly refunding announcement. This chart we use is from Warren Pies. It's pretty simple. When the Fed said that they were going to raise $1 trillion, the stock market got hammered and bond yields exploded. When Janet Yellen wised up and said, well, we'll only raise, $800 billion, the stock market rallied and yields went down. And yesterday, the number came in lower than expected. So, $55 billion. And by the way, it's so crazy, right? Because it's still a lot of money, $760 billion. Still, we must learn now, tomorrow we'll learn the composition of all of this. And that's going to be important as well, because if it's a lot of bonds, that's going to really probably make yields go higher. I want to bring in TrendMacro Chief Investment Officer Don Luskin. Don, so I think Yellen has learned how to play the game. The street obviously cheered. We had a big rally into the close, but still $760 billion in 3 months. That's not really good news, is it?
Well, it is less than what was expected. So, I'm a small government guy. That means I'm a small government debt guy. So, any number larger than zero here is going to thrill me. But I would just like it to be as small as possible. And for everybody who's just hanging on the edge of their seat with, white fingernails, worrying about the old debt to GDP ratio and how we're circling the drain and going into a debt deflation spiral and all that jazz, I just want to remind you that the debt to GDP ratio has been rock solid for 2 years. It's not going anywhere. I mean, sure, yeah, debt's going up, but so's the economy. Did you know that from 4 years ago, just before the pandemic, the U.S. economy is 30% larger? Well, of course we're going to have more debt. It'll be fine.
All right. On yesterday's show, Stephen Myron explained that he had written this great article about the Fed's monetary handover, what he says of inflation risk. It's sort of a stealth politicalization of monetary policy. This sort of relationship between the Federal Reserve and the Treasury Department. Are you comfortable with that?
Well, yeah. Okay. So I read the article. I think of Myron as a friend. It's great. We should focus on it. But the only issue here is whether the Treasury is going to issue short-term bills or long-term notes and bonds. And the theory is that if they issue short-term instead, that's a form of QE. Now, that doesn't make it monetary policy, because QE wasn't monetary policy in the first place, even when the Fed did it. It doesn't change the amount of money in the banking system. It just changes the amount of maturity risk and duration risk that the Treasury wants the banking system and the rest of the private sector to bear. So, the Treasury has always been in the business, like any issuer, of figuring out what the market will bear. And if it wants to make the market bear less risk, if it thinks it can get advantageous financing terms for doing that, then fine. I don't think we need to engage in, I use the word very guardedly here, but what amounts to a conspiracy theory that there is some kind of backdoor monetary policy going on at the Treasury. It's not. It's just issuance policy. We've been doing this for 200 years.
So tomorrow we get the Fed, we get the FOMC. Obviously, everyone's going to be watching Jay Powell. Now, from what I gather, I was reading some of your notes about maybe chatter, from Fed watchers that the Fed will start to hint that they're going to end quantitative tightening. How critical is it? Because obviously Jay Powell's got to alert us before they start to do any cuts, right? They've got to give us some sort of signal.
Yeah, well, the Fed has completely lost control of its messaging, because at the last FOMC press conference, Powell just said, quote unquote, we are not talking about slowing down QT. And then in the minutes of the meeting that were released 3 weeks later, there was this big discussion about slowing down QT. So, I just don't know what to believe anymore. I don't know what they believe they want us to believe. But I will tell you this. When you are in an emergency, when you're in a banking crisis like 2009, when you're in a global shutdown like 2020, it makes all the sense in the world for the Fed to do QE. It really is easing, because they're taking duration risk out of the market by buying long-term bonds. It goes back to that question about the Treasury. But when times are normal like they are right now, reducing the Fed's balance sheet is not QT. It's not tightening. Because right now, nobody cares about risk. It's not a problem. There's no bank that is worried that, oh my God, I can't hold a 3-year bond. I can only hold a 3-day bond. Well, that's what QE was about. So QT, it's not a thing. So let them slow it down, let them abolish it, let them keep doing it. It doesn't make any difference, except it's something for Fed watchers to talk about.
Well, we'll be talking about a lot of stuff. Everyone's a Fed watcher tomorrow, Don. Thanks a lot, man. We'll talk to you again real soon.